Hi, you're watching Investor Insights, and today I'll be talking about bubbles. Now, I've made videos before talking about the ones that you're experiencing right now, but today I just want to talk a little bit and discuss a few thoughts about bubbles themselves. First and foremost, bubbles, speculative bubbles, just occur when everybody's trying to jump into something because of either sheer stupidity, the crowd mentality, being uneducated, fear of failure. That comes from seeing everybody else make money from something and you staying out. You gotta get in because you don't want to fail in relation to everybody else. Bubbles happen. They happen all the time, and it's not just stock market bubbles. You get bond market bubbles. You can have bubbles within currencies, and you certainly have bubbles within the real estate market. And it's important to realize when you're within a bubble, you don't really feel anything. You don't read about it because most people don't want to talk about it. This is the scary thought. Whenever you're actually living through a bubble, nobody wants to admit it's a bubble itself. You got these financial lemming commentators who will come in and say, no, forward estimates are getting stronger, the economy is recovering, everything's all sound. Man, I do not see a downside. And then you've got people like the analysts who are just as big a lemmings as everybody else out there, who will just react to the momentum of a stock. So that if it goes up, man, they just ratchet up estimates. And if it goes down, well, they just crush them. Analysts are just reactive little lemmings. But more importantly, the most important person that should know about a bubble is the investor. That's you. Just because everybody's piling in doesn't mean that they're right. The bubble can keep on inflating for quite a little while yet. But just keep in mind, when things implode, everybody gets killed. Except you, hopefully. An important consideration or thought that you should have about bubbles is that they can form over a long period of time. They can last a long, long time. But the general advice that I have about bubbles is the longer they take to form, obviously the bigger that they get. But when the implosion comes, there's going to be blood all over the streets. The higher it goes, the steeper the fall. Now, stocks fall 3 times quicker than they get up. So take a look at tech wreck in 2000. The hyperbolic phase of the rise happened over basically 1 year. From early 99 to March of 2000, the Nasdaq 100 doubled. And although it took a year to double, it took about 3 or 4 months to raise all those gains. So roughly about 3 times quicker than it falls. 3 times falls, 3 times falling quicker than it gets up. You don't want to be caught up in that. You don't want to jump in like a lemming when everybody else is jumping in. I know I keep on saying this over and over again. Just because a stock goes up doesn't mean it's a good investment. And just because everybody else is doing it doesn't mean you have to join the crowd. This bubble that you're in now with the bond market has lasted 5 years, and it's slowly being deflated now. The stock market bubble, especially in the States, is just being blown up bigger and bigger and bigger. Nobody wants to admit that PE ratios are just ridiculous. And nobody's going to admit that things are overpriced. Everybody, through no fault of their own, because they're just a bunch of lemmings. And people, especially the analysts, they're just a bunch of reactive commentators. They can't work things out for themselves. They see something happen and they comment on it. And then last but not least of all are the actual hedge fund gurus or the managed investment community. The big managers come out and they will tell you things are fairly priced, but based on the acceleration in the growth of the economy, there should be a lot of momentum in the stocks, and we estimate things to be much better. We estimate 10%, we estimate 15%, we estimate all sorts of things. But they have to say that. You will not see one fund manager who comes out and tells you, man, I think things are looking a bit pricey. I think the market is overheated. I think you should stay out. No one's going to say this because they want your money. And no one's going to get your money if they say that things are looking a bit too rich. They have to entice you to join their funds. So just because somebody says that things are looking good doesn't mean that it is. So when you're not sure of what to do within a bubble cycle and you're itching just to do something, take some time off. Don't put any money on the table and watch and learn what happens. Because more likely than not, when Armageddon strikes and these bubbles get burst, you're going to wish or you're going to be happy that you had stayed out. Sure, you may have missed out on the way up, but you're going to be glad that you didn't take part in the ride down. And as usual, with investing and trading, you've always got to consider preservation of capital and the downside potential. So until next time we meet, make sure to take into account before your investing or trading decisions that the markets right now have been distorted by the central banks. And don't believe anything you hear from these commentators, from these financial gurus, from these financial wizards, and these analysts, when they tell you that everything's okay, but you can clearly see and clearly work out that things are wrong.